Gold just touched an all-time high of nearly $5,600 an ounce earlier this year. And right now, it's still trading above $4,700, up more than 40% in 12 months. So if you're a late starter trying to build wealth in Southeast Asia, you've probably asked yourself, should I buy actual gold bars? Or should I just buy a gold ETF through my broker? Today, I'm going to answer that question with real numbers, real trade-offs, and my honest recommendation for SEA investors. Gold is having one of its biggest moments in decades, and here in Southeast Asia, and especially in Indonesia, the data is extraordinary. In Q1 2026, Indonesia recorded a 47% jump in gold bar demand. Across Asia, physical bar and coin demand hit an all-time quarterly record of 474 tons, up 42% year-over-year. Meanwhile, Western ETF investors were actually selling. Same gold, opposite decisions. Who's right? That's exactly what we're going to figure out today, and I'll tell you up front, the answer is not as simple as most people think. Let's start with the case for buying physical gold bars. Number 1, you own it outright. A gold bar in your hand or in your safe has zero counterparty risk. No broker, no ETF manager, no custodian bank. If the financial system has a bad day, your bar doesn't care. Number 2, no annual fees. A gold ETF charges you every year just to hold your position. A gold bar charges you nothing after purchase. Number 3, it's tangible wealth. In Southeast Asia, gold has been a store of value for generations. Antam bars in Indonesia are universally recognized and easy to sell locally. Number 4, privacy. A physical bar purchase can be done with minimal digital trail. And number 5, the data backs it up. Asian bar demand reached 397.7 tons in Q1 2026, the highest on record. Asian investors are asking a different question from Western investors. Not what does gold yield, but what will this ounce buy me in 10 years? Case against physical gold bars. Because there are real costs most people don't talk about. First, buy premiums. When you buy from Antam or a dealer, you pay above the spot price, typically 1 to 3% for bars and 3 to 8% for coins. That premium is a cost you have to recover before you even start making money. Second, storage. If you store professionally, at a vault in Singapore, for example, you pay ongoing fees of 0.1 to 0.5% per year. So the no annual fee advantage starts to erode. Third, liquidity. Selling a gold bar is not instant. You need a buyer or dealer. You may not get spot price. Fourth, authentication risk. Fake bars exist. Buy only from accredited sources. Pamp Suisse, Valcambi, Perth Mint, or Antam in Indonesia. And a special note for Indonesian investors buying from Antam directly. You will need your NPWP, your tax identification number, and Antam will apply PPH-22 withholding tax of 0.45% if you have NPWP or 0.9% if you don't. If you buy from a local gold shop instead, no NPWP is required, but prices may be higher and quality varies. Now let's talk about gold ETFs. For SEA investors using IBKR, you have access to 4 main US-listed gold ETFs. First, GLD, SPDR Gold Shares, the biggest and most liquid gold ETF globally, with over $155 billion in assets. Expense ratio, 0.40% per year. Best for active traders who need deep liquidity. Second, IAU, iShares Gold Trust. Lower cost at 0.25% per year. the most popular choice for long-term buy and hold investors who want the best balance of cost and liquidity. Third, GLDM, SPDR Gold Mini Shares. The lowest cost among major funds at just 0.10% per year, $33.5 billion in assets. This is the mathematically superior choice for most buy and hold investors. Fourth, BAR, Granite Shares Gold Trust. Expense ratio of 0.17%. Gold stored in London vaults. A solid alternative if GLDM is unavailable on your platform. All four hold allocated physical gold, real gold bars in real vaults. The difference is just cost and liquidity. The case for gold. ETFs. Number 1. Instant liquidity. Buy or sell in seconds through IBKR. No dealer, no premium negotiation. Number 2. Fractional ownership. You can invest any amount, $10, $100, without buying a whole bar. Perfect for DCA investing. Number 3. No storage headaches. The ETF custodian handles everything. Your gold is in institutional vaults audited regularly. Number 4. Price efficiency. You buy and sell at or very near spot price. No 1 to 3% buy premium. Number 5. Portfolio integration. Gold ETFs sit right in your IBKR account next to your SMH and QQQM. One platform, one portfolio view, one tax statement. And the cost argument is real. GLDM at 0.10% per year costs just $100 annually on a $100,000 position. That's genuinely cheap exposure to gold's full price performance. The case against gold ETFs. And this is where CA investors need to pay close attention. First, annual fee drag. Even GLDM at 0.10% compounds over time. GLD at 0.40% costs around $8,000 over 20 years on a $100,000 position. Second, you don't physically own the gold. Your ETF share is a claim on gold, not gold itself. If the fund's custodian fails, your legal protection depends on how well the gold is ring-fenced. Third, U.S. collectibles tax. Physical gold ETFs are classified as collectibles by the IRS, meaning a maximum 28% federal capital gains tax. That's higher than the 20% rate on equity ETFs. For Indonesian investors using IBKR, consult a tax advisor about how this applies to your specific situation. Fourth, currency risk. Gold is priced in US dollars. If the rupiah strengthens against the dollar, your ETF return in rupiah terms could be lower than the USD performance suggests. Fifth, no tangibility. In a genuine financial crisis, the scenario where gold matters most, your ETF is a digital entry. A bar is real. Let's put them side by side. Cost efficiency over time. ETFs win, especially GLDM at 0.10%. Liquidity. ETFs win hands down. Counterparty risk. Physical bars win. Tangibility and crisis protection. Physical bars win. DCAEs and fractional investing. ETFs win. Storage and logistics. ETFs win. Privacy. Physical bars win. Tax simplicity for Indonesian investors. Bars have PPH 22 only. ETFs have US collectibles tax complexity. The honest truth, neither is universally better. They serve different purposes. Physical gold bars are a long-term wealth preservation tool, generational store of value, Zero counterparty risk, tangible. Gold ETFs are an efficient, liquid investment vehicle, perfect for portfolio integration, DCA, and active allocation management. The strongest approach is to combine them. A physical core for direct ownership and long-term preservation, a gold ETF layer for liquid, efficient exposure you can manage within your brokerage account. So what's my personal pick? If I could only choose one of these 4 ETFs for my retirement portfolio, it would be QQQM. Here's why. It has the lowest expense ratio at 0.15%. It gives me exposure to the most dominant companies in the AI revolution. And it's the cleanest vehicle for long-term DCA with minimal friction. But honestly, I own all 4. Different sizes, different roles, different purposes. Because diversification, even within the AI theme, matters. The AI supercycle is not a short-term trade. This is a decade-long structural shift. The companies building the infrastructure for AI, the chip designers, the memory makers, the cloud platforms, they are the railroads and the steel mills of the 21st century. If you're a late starter like me, you don't have 20 years to wait for the market to come to you. You need to position yourself where the growth is happening right now. And right now, it's AI. And these 4 ETFs are your best tickets to ride. If you found this useful, please hit like and subscribe. I'm doing a series this week on exactly how I'm building my retirement portfolio in my late 40s, with real numbers, real positions, and real strategy. And check the description. I've linked my free retirement calculator so you can run your own numbers. See you in the next one.